Hey, everybody. Good afternoon. This is Doc Severson and Dave Lukas here of 12 Minute Trading. Today's Monday, the 24th of April, 2023. And big surprise, the market's going nowhere today. It's in a very small range, which is the same thing as the past 3 weeks. So it's something that we talk about as being this chop suey. So, Dave, what do you think? Is the market going to sit in this range for a whole lot longer, or what are we doing?
No, I think this market is going to rip at relatively soon, and we do not know the direction. The You'll probably pull it up a little bit. The daily energies are supercharged, and they're at a point where they are like on the case of like the NDX, the highest I've seen in a year. So things are going to start moving. I think it's gonna start this week ahead of the Fed. We could stretch this all the way to the Fed decision. That would be some serious time to be flat like this in Groundhog Day, with these days where we drop in the morning, buy back in the afternoon, end up moving like a point or two on the SPX. I mean, this is like pre 2008 markets where it's like, a 10-point move in the SPX was a big deal, right?
Yeah.
I don't think anybody's used to that. And because of that, I think what's going to happen, and we're getting close because I think anybody out there can feel it, and we can talk about this today, is that you get to a point, a lot of traders are getting to a point where they're getting antsy, right? Because they're not used to this market. We've been used to 50-point daily swings in the S&P and stuff like that. And eventually somebody's going to break and they're going to make a wrong move, and that's going to trigger a bunch of things. And it could come off some news like Microsoft earnings tomorrow or something like that. But it's kind of one of those things, like if you can't take it anymore, because you've been waiting to enter a trade, and then you enter that trade in about right now, and this time is when the move's going to happen and get you going the other way and get you in trouble. So, gosh, patience is tough, but that's what we need right now.
This may be one of the few times out there, and we don't say this very often, but this may be one of the few times where it may pay to be an option buyer rather than a seller, as long as you do it smart. I mean, we're not suggesting you go out there and start firing away puts and calls on things, like Wall Street bets or something like that. But the risk premium is so low right now. It's like if somebody was out there on the Florida shore selling you hurricane insurance on a perfectly beautiful day, and it was selling you for like a dollar for every $1 million of policy. It'd probably be worth getting some of that asymmetric risk. And that's kind of what we're seeing in today's market.
Especially with the pricing premium and options, it's just like whoosh, like the balloon has come out of that. And well, let's say I would expect it not to last, just because of the environment we're in with zero DTE and all the other things that we have nowadays. It seems like options premium should be higher historically than historical times, now that we're in that world. But as of now, it is definitely priced in a way that if we get a big move, especially to the downside, it's going to shock people what's going to happen with options prices. You can be in a trade that is literally profiting big time today, and you get that big move, and all of a sudden you're underwater with the way that the trade and the options premiums are being priced right now. So that's another reason where it's like, let this thing play out, let this market show its hand, because whichever way it decides to go, we've got a daily chart that's fully charged. We've got a weekly chart that's fully charged. We've got a monthly chart that's fully charged. It's like dominoes, right? Once the daily starts to release, and it kicks into the weekly and the monthly, we could have a trend that kicks in for a number of months at this point. Mm-hmm. And we've got a lot of catalysts for it. We've got big time earnings. We've got the Fed. The debt ceiling is now starting to, if you notice, the debt ceiling is now starting to become a news headline.
Want to do a vote on it.
Yeah. The market finally found that, right? So the next 3 to 4 weeks are going to be really interesting.
Let me, if you don't mind, I'm going to run this over here and show people a couple of topping points here today. So first of all, here's the S&P chart, and I've got a number of gaps. So you see these gray boxes here. These represent overnight gaps that happened in the S&P futures market where the cash market has not been able to catch up yet. So those end up being targets. Those everybody can see these gaps. Now, I'm not suggesting that we're going to drop all the way down to 3,500 and fill this gap or not, but man, these ones just above 4,000 are ripe for the picking. So that is out there. Now, one thing I have not seen a market this quiet for a long, long time. And what this reminds me of is, if we go back in the Wayback Machine here, it reminds me a lot of this period here, like at the end of 2015 or into the middle of 2015, where all of a sudden it's like, what you want to be selling and you're nervous about it. You're nervous about it. And finally you just get tired and you get bored and you just say, well, what's the worst that could happen? And then whoosh, everybody gets taken out to the downside. So this is the greatest losses that I've had over my career have been when I lost patience during times like this. Notice also what happened here back in 2016. So we had from the bottom here, we rally up into the summer and then we go absolutely nowhere. And then what happens is Brexit comes out of left field. Nobody was anticipating that. Mm-hmm. And that shocked the market. So it's almost like those the paddles that they put on, patients that have heart problems, the shock defibrillators, right? It's almost like it's exactly like that. And then of course we know what happened here in November of 2016 was the same thing. We had the same type of market, which just wasn't moving at all. And so these are reminding me of this 2015, 2016 timeframes for that. Now, Dave mentioned about energies. So we've got a very, I would say, rare situation where we have all of these major timeframes on the S&P 500, and they are wound up like nobody's business. Now, we are starting to detect a little bit of a trend. This is the weekly chart is starting to detect here. Mm-hmm. I've only got a 9 period on this, and yours might be a much higher on that, because as we start to lose some of these candles back from the banking crisis, this is going to end up being a very linear. So to me, this is almost anticipating this weekly consolidation. But man, across the board, we typically see these numbers and we're ready for movement when we see this. So now the question becomes, is this going to break to the upside or to the downside? And that's the question of the day, obviously. But over time, if you look at these things, the challenge here with breaking to the upside is, I think if it was going to break to the upside, it would have done so already, right? So it would have taken a banking crisis and just squeezed the bears out all the way above 4,200. It was unable to do that. I guess it was just too far to do that. So
well, that's the thing. We're in one of those weird times where we're sandwiched between. We have banking crisis. We've got the most telegraphed recession in history. We've got the debt ceiling. We've got the Fed coming up. The next meeting of the Fed's really important, not just because they're going to do. I mean, I think there's like an 88% odds of a 25 basis point rate hike, right? Which the market's priced all that in, right? So everything's priced in for that. It's what the Fed signals they're going to do in the future from this. That's really going to be important for the markets. Remember, the market's a forward-looking instrument. It's always trading off of what it thinks the future is. And at the underpinning of it all is earnings, right? So if the market thinks earnings is going to be better in the future, the market's going to trade higher. If they think it's going to be lower, it's going to trade lower, right? But what the Fed does affects that and affects what earnings can be. So the signal that we're going to get from the Fed, this press conference, is probably going to be one of the most important, because if we're at the end of the cycle, what do they say about going forward for the future, right? What does that look like? And we're still pricing in rate cuts this year. And I don't necessarily see that. The bond market is, though. So
I think there's, I've wondered about that too. And I think obviously we're sitting at a 90% chance of a 25 basis point rate hike. Now, that may change as of Friday with a PCE that comes in, because that's still the Fed's favorite inflation metric and barometer for that. So it may change. It may change not all that much, though. But so then everybody's going to say, well, okay, so we're still sitting at 25 basis points. What's the Fed going to telegraph about future rate hikes? It does not.
Exactly.
It makes no sense for them to telegraph anything, because all that does is just left egg on their face in the past. Yeah. So I think the Fed is going to be very, very close to the vest in terms of, they're going to signal something neutral, like, well, we're going to be data dependent, going forward on things, and everybody's going to go, boo, boo. People in the audience are going to be booing him and stuff like,
it's going to come down to the press conferences and how he answers the questions again.
Right.
The statement's going to be this.
I think we've lost you, Dave. I think we have lost Dave. So, there, you're back.
I think you lost me for a second.
Yeah, we got you back. So I was tap dancing for a while there.
On that.
Hey, by the way, if there's anybody that's out there that's watching live today, we realize that most people watch this on a replay later on when you get back from work and things like that. But if there's anybody live that's out there today that has a question that wants to bring it in for Dave or myself, please do so. We'll be here for another few minutes. And then, by the way, if there's somebody that's watching this on the replay and wants to get into question for next week, we'd love to hear that. So go for it, guys.
Send it our way. Yeah. Yeah. And so, Doc, when I don't know if you heard when I was talking about when I got cut off, I was just talking about how the Q&A is going to be really what moves probably things on next Wednesday with Powell, because the statement will be the benign statement, as you kind of said. It's always the questions that trip him up and his answers to that where he gets off script and it gets ugly. So we'll have to see how that goes. But I do think the market will probably start moving a little bit before then, because I think we're reaching that point where people just can't take it anymore. And so they're going to do some things up into the Fed, I think. So looks like John has a question. It's a good one for you. Will the 78 minutes tip us off on the direction, like the candle sizes?
Well, let's go to a 4-panel fractal chart. So John doesn't want just a 3-panel. We're going to go to a 4-panel. So this is the way that this is built. For those of you that are wondering why on earth are you putting a 78-minute chart. So this is the monthly. And then if we use our factor of 5, kind of our factor of 5 time frames, let's, with a little bit of creative license here, we've got roughly 5 weeks in a month, sometimes, 4, but sometimes 5. And then we go down to the daily chart, and this works out pretty well. There's usually 5 days in a week during the trading week. And then if we have 6.5 hours, if you divide 6.5 trading hours divided by 5, you're going to find that it's going to be about 78 minutes. And so this is something I did a few years ago, and next thing I know, I see everybody out there running with a 78-minute chart. It's funny how things just sort of propagate around the world of trading. So this is our 78-minute chart that John is asking about. Now, John is aware of rule number 2 of fractal energy trading, which is that reversals start from the inside out. So rule number 1 is that larger time frames dominate the trend, and we still have a monthly uptrend, believe it or not. This is still a higher low. This is not yet a lower high that's set up. So we still have a monthly uptrend. But rule number 2 says that reversals start from the inside out. So if we're going to see a reversal, John, we would see something like this, where we'd see a lower high setting up like that, and then followed by a lower low, and you'd see that change in polarity to the downside starting on the 78-minute chart. Now, the thing I will say is that that's easy to say in theory, like, whoa, 78-minute chart will show a reversal. In practice, it usually happens really fast, right? All of a sudden, something comes in from left field that the market's not happy with. It adds uncertainty. And so especially downside reversals can be violently fast and can occur literally in minutes, where all of a sudden it's like, wait, you're not supposed to do that. You're yelling at the chart saying you're not supposed to do that. You know that you're on the wrong side of the price action.
Say maybe Microsoft earnings or guidance tomorrow after hours that kicks it into play. So that's how it happens on Wednesday, right? So I actually think Microsoft could be a catalyst, depending on its guidance, because it does become a bellwether. It's the first of the big techs, right? So people take a cue from that. You got Google up next, you got Meta, you got Apple the following week, all that stuff. So I think Microsoft earnings, Amazon even this week too. I think what is it? Something along the lines of a big bulk of the S&P is reporting this week, like 30 or 40% or something like that. So
yeah, it's
I wouldn't be surprised. Yeah, I wouldn't be surprised actually, and this could actually be healthy. 3 to 5% haircut, go down 3 to 5%, put in a new, essentially a new higher low, and then bounce off of that. I think that would feel really bad, right? Especially after this much inertia, right? We come out of that and we just tank down, and everybody think this thing is just going to fall off the cliff, and then we find a new kind of higher low somewhere above that 3,800 level on the S&P, and then rip up to the upside, especially if the debt ceiling is taken care of. Right, I think that's would be actually healthy and beneficial to continue a new bull market if that's where we're at. So, don't think that just because we do drop 3 to 5% that it's over from an uptrend. Right, I think that's important here too.
Yeah, the thing that we've learned over and over again is that to go higher, sometimes you have to drop and go lower first. I mean, how many times have we seen this? Like we saw this back in October, November. We had this sort of, false breakout on CPI, and then we end up dropping like a stone, and everybody's like, oh no, here we go again, so we get Eeyore and sad face and everything like that. And then boom, next thing you know, as we get into the end of January, we're up at 4,200 again. So this is what we're talking about, is like sometimes the market, to go forward, you have to go backwards. To take 2 steps forward, you have to take 1 step backward. And so, can we get above 4,200? Probably not on a breakout right now, especially coming all the way down from 3,800 to expect this to break out. Even though there's energy all over the place right now, we may have lost that negativity, and the negativity is what really is helping break things higher long term,
And
right?
a lot of liquidity is coming into the markets. Over $1 trillion in liquidity over the last month came in the markets.
All
and
that money market funds are sitting on the sideline.
Yeah. And so you've got and you keep this up because Phil has a question that'll be good to have this up for. But the big thing is you've got a lot of liquidity coming in. You've got a lot of these big groups that are taking advantage of these pullbacks when they happen, and you can kind of understand the change in polarity, right? Once you get that higher high and that higher low, you start to set the bars differently, right? You're not setting new lows anymore. You're setting, those new bars. And so then you go up to your next level, right? And there you are, and you pull back. But at some point, people look at it and they say, okay, we've gone 5%. That's a good time to come back in. And that becomes your next higher low. And you can kind of see how this turns like that. It's a lot of it's emotion and human nature, but it's also, good time to step in and buy, right? We've gotten a 5% pullback, good time to pick up some of these stocks that, have been high flyers and buy back in, right? Take advantage of that. Phil had a question on the rut, and you've got that up now. And we've talked about this a lot, is the rut being in the canary in the coal mine a lot of times. The rut essentially basically being the one that moves ahead of the others.
Here's
and as a way to kind of signal stuff.
Here's what Phil's talking about. So back in November, this is November of 2021, where the rest of the market was still heading higher. The Russell puts in a spike high and then starts, right up here and starts selling down from here. And I remember when this happened, it was like, hey, wait a minute, what's going on here? The Russell did lead the rest of the market to the downside. Now, if you look at what's happening right now, this is actually a month.
It's actually leading right now again in the fact that it hasn't gone anywhere.
Well,
and it hasn't for some time.
This is a monthly bear flag. That's what this pattern is. And a bear flag is any flag pattern is a halfway house in the middle of its destination. So if you play this out to the expected or the measured move from here, we're sitting at maybe like 1,300. Now, with that said, I'm not necessarily bearish on the Russell at this point, because what can happen is, if you watch this carefully, if we start to see the Russell break above the 200-day moving average again, then this could actually lead markets to the upside again. The problem with the Russell has been we've had markets leading, such as the Dow, and everything changes during let's see, Yeah, everything changes during bear markets. You typically get new leadership coming out of a bear market. And so we had all those industrials and energies kind of leading things out of the bottom to begin with. And then we've seen the second wave has been the NASDAQ. The problem with the Russell has been all these small little energy companies and small little financial companies like, regional banks and things like that has just been destroyed lately.
And we just had a comment on that too. And it's true. In fact, the Russell looked like it was going to lead out of this until that happened with the regional banks.
Exactly.
It came down perfectly, like on the weekly chart, hit the lower Bollinger Band, bounced a little bit off it, started to go higher. Then the regional banks hit, it just has stayed there, right? And it's kind of interesting because it stayed there and it's basically been going nowhere ahead of everything else going nowhere. So in some ways, it did lead the way to the fact that the market was going to be in a kind of just this Groundhog Day chop suey environment ahead of the others. It was probably, I'd say a couple of weeks ahead of the others, and it's just stayed there. So keep watching the Russell because it may break out sooner than some of these others do even this week. So watch the Russell because it definitely can still be the canary in the coal mine. So
so watch the Russell to break above 1,800. If it's able to break above the 200-day moving average at 1826, that will be important, and we could actually get a true breakout from there. But the Russell energies are just wildly elevated right now. So everything. One last
point to this is why, right? So a lot of people are like, okay, great, the Russell can lead. Why does the Russell become the lead? Here's the big difference with the Russell versus a lot of the other indexes like the S&P and the NASDAQ and stuff, is these big fund managers and stuff, when they're building positions, right? A lot of these Russell, these are little smaller cap stocks. So if you move 1 million shares in a smaller cap stock, everybody sees it. They know what you're doing, right? And they all pile on, or they go against you, right? So these fund managers have to build positions in like rut stocks at a slower pace and unwind them at a slower pace. They can't just, like you can go in and trade, 10 million shares on Apple right now. It's not going to make that big of a deal. It's happening all the time. Yes. You trade 10 million shares on a Russell stock, everybody and their brother is going to see it, or the Bloomberg terminal. They're all going to know what's going on.
Right.
And so you have to do it much slower and over a lot longer period of time. And that's why you see the Russell a lot of times be kind of that signal, a lot of times 3-4 weeks ahead of the rest of the market. And so just, little inside baseball to, traditional trading and kind of how it works with that. And I think that's important.
Yeah, so Russell 1800 right now. Watch Russell 1800 and see, keep score at that point. It has
had trouble getting over it and keeping it.
Yeah. So let's see. Well, I think we've answered all the questions, and that's
most of the questions.
Yeah, that's kind of the point that I wanted to see. We're, obviously things will lead up until next week. That's going to be extremely important. But just keep watching the price and don't become impatient. This is where a lot of retail traders will get stepped on because they get impatient, and we know we're about to get a big move. Let's let the market, we're not going to stand in front of the freight train and say, "Halt, wait a minute, you're supposed to be stopping at the Bollinger Band." And it's not going to happen.
I sent out an alert today for all my students because I always enter new trades on Monday, and I took the GIF from Braveheart where he's going hold, and put it in there because that's where we're at. Just hold, because that's it's that time where you can't take it anymore. And you slap on that trade because I'm supposed to trade on Monday or I'm supposed to do a trade, then you get run over, right? So for this week, I may not trade till Friday, right? I may take this week off. Sometimes the best thing to do is not make a trade, especially if you've got a move this large that's about to happen and it doesn't go, right? Just be a little bit patient. You'll reap the benefits on the back end and really be able to take advantage. When this goes, you should be able to sell and follow it all the way in the direction it's going to go for a number of weeks. So great opportunity coming up.
Yeah, I like this comment here. Impatience makes you a mental patient. Yeah, couldn't agree more. All right, everybody. Hey, thanks for joining us here today. For those of you that did join us live and for those of you joining us on a replay, again, thank you for checking us out. And don't forget to subscribe to our YouTube video channel. That way you get notified every time we light this thing up. So looking forward to seeing you guys next week. And thanks for attending today. So from Doc here in Greenville, South Carolina, there's Dave and myself. We're 12 Minute Trading. And thanks, everybody.
See you guys.